You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, we'll start with a review of last week's trade. Today is Wednesday, September 8th, as we tape Options Playbook Radio. The markets are closed. Had a little bit of a down day today. IWM was down the most, and that's what we looked at last week, but nothing too concerning as far as the chart is concerned. It kind of just came back within its trading range, down about 1% on the day. Then the Dow and the NASDAQ and the S&P 500 index were down a little less than that. What I do find interesting is that the S&P 500 index was down today, and we actually saw the VIX actually go down a little bit by the end of the day. Just a smidge, though, but it's a little bit odd that you wouldn't see the VIX spike up whatsoever. Sometimes that's a little bit of a contrarian indicator, kind of showing maybe we'll open up in the morning, but it's only one indicator overall. The breadth of the market wasn't that great in general. Just kind of odd to see the VIX stay flat or go down on a day that we had all the different indexes down overall, encompassing the market. All right. So with that said, we're going to go back and look at the IWM trade, which actually it did all right overall. We did a butterfly in IWM, the Russell 2000 Index ETF, last week. And that butterfly was based on, we're hoping that it would get to the higher end of the trading range. The IWM has not set a new high in about 6 or 7 months, as opposed to all the other major averages that really have. So we were hoping that it would get to the higher end of that channel. And if we did see a breakout, that would be good for the markets overall. But we do have September, we do have October. September over the years has not performed as well as other months in the marketplace, but that's going way back in time. Last few years, it's done okay, but in general, people just seem to get a little bit nervous when September rolls around. So last week, here's where the trade was. We had the IWM, the market was open at the time. The IWM was trading at $227.55. We just did a little bit of an out-of-the-money butterfly. We're doing the September 17th expiration, so there's still 9 days remaining in that trade. And we basically reduced our risk by doing the butterfly. We were speculating that at 232 was basically the resistance point to the upside. And so we bought the September 17th, 228 strike call, sold 2 of that same expiration 232 strike calls, and then bought 1 of that expiration 236 strike calls. So September 17th was the expiration. The midpoint was right around 87 cents. That means that was your max risk. The market is down today, down overall since last week. Like I say, though, as far as the chart is concerned, we have the 50-day and the 20-day kind of converging right now. That's basically adding a little support, and there's a long-term trend line going all the way back to the downturn of the pandemic last year. That is kind of holding steady too, right at that range. So we see this butterfly, if I get a quote on it, as of today, the IWM is at 223.92. $223.92. It's down $2.47 on the day. And this butterfly is still trading at 53 cents. So you're down 34 cents on the trade. If it made you nervous, you still got 9 days remaining on the trade. If you're a little nervous from the downturn, well, you haven't even lost half of your investment yet. So you might want to sell and get out. There's also an alternative trade that you can look at. I'm not necessarily saying that this is what you should do at this point in time. And as always here on Options Playbook Radio, nothing is meant to be a recommendation. We're just talking about strategies. And ideally, when the market goes against us, it gives us an opportunity to talk a little bit about alternatives. Now, overall, especially on, I think this was a 17-day trade when we started. When you're looking on a shorter term trade, I usually would maybe make one adjustment. Very rarely would I make 2 adjustments. Ideally, I would make an adjustment, and if the market kept going against me, I would just get out of the trade as opposed to keep churning the account and creating commissions and battling with bid-ask spreads. So my one adjustment that I like to do when I have a butterfly on is to actually roll it into a short call spread in this situation. Okay, so the way that we would adjust this trade is we're going to adjust it right within the butterfly. And we would roll it into a short spread. Now, the market isn't that far away from where we started, so there's still some value in this butterfly. As I mentioned, it's trading for right around 53 cents at the midpoint right now. And as always, this is not meant to be a recommendation. We're on Options Playbook Radio. A lot of times we learn more if the trade has gone against us, because we want to talk about what everybody kind of knows what to do when you're right on your forecast, right? It's easy to take a profit, but it's harder to take a loss. Especially retail customers have a way of just playing the hope game, especially when it comes to for options. So we're going to do an alternative where we're going to roll into an additional short spread. We have a short spread in the butterfly already. We're short the 232 strike call, and we're long the 236 strike call. That's one short spread. We've also sold an additional option, the 232, right? That goes along with our long spread that we have, where we bought the 228 strike call, sold the 232 strike call. So those 2 spreads make up our butterfly. So how do we adjust this? Well, quite simply, we're going to sell the most expensive option contract. We're going to sell the closest to where the underlying is at, which is the 228 strike call. That's trading for right around $1.10. We're going to sell to close that position. Now, if we do that, we need to protect ourselves. Why? Because we are short 2 option contracts, and now we are only long 1 option contract. So we're going to go back to the 236 strike call, and we're going to buy an additional one. And that is now fairly decent out of the money. It's actually only trading for 10 cents on the bid, 11 cents on the ask as we speak here. And so we're going to roll into a short spread, which means we're going to end up being short 2 short spreads. And the strikes would be short the 232 strike call and long 2 of the 236 strike calls, staying in that same expiration. Now, if we do that, we actually bring in a net credit of $1 to the account. We have an additional risk. You have 2 short spreads, So you have a margin requirement now of $4 or $400, $200 for each spread that you have on. But we've now brought in a net credit to the account of $1, and we paid 87 cents for it. We have 9 days remaining to the expiration date. And this becomes a trade where you're just saying, I don't want the cheese anymore. Just let me out of the trap. In that situation, we paid 87 cents. We'd bring in $1 here. We'd have a 13-cent net credit. But we have a lot more risk than we initially had on the trade. All right. So we started with a butterfly, September 17th expiration. We did this last Wednesday. The market was open. We bought the 228 strike calls, sold 2 of the 232 strike calls, and bought 1 of the 236 strike calls. Our adjustment would be to go out now and sell the 228 strike call, take those proceeds, and use those proceeds to buy an additional 236 strike calls, effectively creating 2 short spreads in my account, but making the entire position now done for a net credit of 13 cents to the account. You will have 9 days remaining. You'd like the market to stay where it's at or go lower. So your forecast has definitely changed overall. As I mentioned, this is not something that I would probably do on this trade. And nothing is meant to be a recommendation. You never know where the market's going to go to next. But I always like to talk about a possible hedge that you can do on a trade that went against you, especially on butterflies overall. Okay, so let's look at another trade today. And we're just going to kind of focus on, well, first of all, I just want to talk, people get a little nervous. We haven't had a 5 or 10% downturn in forever. As a matter of fact, it's been a real long time in the S&P 500 index since we've spent more than a day below the 50-day moving average. So just slowly going higher overall. So if you are a little nervous about the September, October, we still have a little bit of volatility in the marketplace. We've got the VIX trading right around 17.5. We've got the futures contracts trading up above 20 going out in October and December. So what might we do? I don't want to necessarily get out of a portfolio, but I have some stocks. In particular, there's probably some with some decent gains on it. You might want to think about just doing some cover call writing. Now, that's a little bit of a basic concept that we don't talk about here too much on Options Playbook Radio. But if you have a couple of positions in that have some premium in them and have some decent gains, maybe think about selling a couple of covered calls against either, if you had option contracts, maybe sell some shorter term calls against them, or if you have stocks, maybe think about just selling some calls. That's just a gut check, because if you sell some calls, you're going to still get some decent premiums, and you just got to be prepared that if it gets to your strike, you can either be called away or you want to be prepared to try to roll the option to avoid assignment overall. Okay, so on that theme, we're going to actually look at an iron condor. And once again, on Options Playbook Radio, everything's all about the conditions of the marketplace. We haven't had a downturn. We had a little bit of a downturn today. People are starting to wonder, is there anything in the future here in the S&P 500 index? Are we going to get that 5 or 10% move to the downside? So we have a little bit of premium. So we're going to sell a condor, actually. So we're going to go out and sell. Well, let me tell you where the S&P 500 index is at today. So today, the last trade in the S&P 500 index was $4,514.07. It was down $5.96 on the day. And we're just going to straddle the market with a condor. We're going to go and sell on the upside the 4,400 on the downside, sell the 4,460 strike put, and then buy the 4,455 strike put. At the same time, on the call side, we're going to sell the 4,585 strike call, and then buy the 4,590 strike call. So we're going to bring in a net credit of $1.33 to the marketplace. We're going to go out to that September 17th expiration. So this is going to be a short-term trade. We're hoping that the marketplace is just going to sit here and try to think about where it's going to go to next. We have $5 worth of risk, which is the width of the spread, but the market can only go in one direction. It can only go down or up. It can't it can't go in both directions at the same time. So your max risk is going to be that $5. You basically get to put on one spread for free, if you will, with no margin requirement. So $5 minus $1.33 means that our max risk here is going to be 5 minus 1.33, $3.67 or $367 on that trade. That'll be our max risk, no matter which direction it goes. So I put this trade on, and if it did come down to any of my short strikes, I would maybe look at closing the one that went against me. I really don't want to hang around and hit that maximum loss on the trade, but I'm going 60 points in and 60 points out of the money. So 60 points on a $4,514 index, we're talking about a 13% move overall. And that would be in the next 9 days, going out to September 17th. So as long as we don't get that big of a move, we're getting a decent credit for putting on this iron condor. We had a little bit of a down day today, so we're going to kind of take advantage of that and hopefully try to stay within a trading range over the next 9 days. So I gave you a lot to chew on here on this edition of Options Playbook Radio. So if you do have any questions, you can email me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is very simple. It's @BrianOverby. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.